Hi everyone. Hope you all are safe and doing well. By introduction, I am a financial risk and regulatory consultant working for one of the largest consulting firms in the world. I am extremely passionate about learning and sharing my knowledge for the benefit of others. Uh, this is going to be my first ever learning video, and the goal of this and future videos would be to give you a brief overview of some of the most common financial products and related topics that you have or will continue to stumble upon during the course of time while serving financial industry in some or the other in some or the other forms, right? So today we will talk about repo transactions. You can get simple and easy definitions on several websites out there. But what new we will be discussing in this session is also the different aspects of controls that you would need to keep in your mind vis-a-vis the functioning of these products. Please feel free to reach out to me via the comments in the comment box below if you have any questions, doubts, or you need any clarification after this session. All right. So without taking much time, we'll now move on to the topic of the day, which is a repo transaction. So just to give you a sense of how big repo market is in the US, right? Uh, it is somewhere around 1.2 to 1.5 trillion dollars per day. And yes, you heard it right. The volume I stated is per day. Now, what is repo transaction? It is a form of short-term borrowing, mostly overnight, where two parties agree to sale, and to the. I mean, basically, the two parties agree to the sale and future of the repurchase of securities. Just one caveat I would like to put here is you might see me making reference to the US banks or US markets a lot. Primarily, the reason is because in my 14, 15 years of my career experience, I mean, that is the jurisdiction that I have served most. So please bear with me on that front. Now, coming back to the topic once again. So, especially, and essentially, you can consider the repo market as a huge pawn shop in layman's terminology. So let's say, and you can actually look at the diagram here that I'm flashing on the screen. Let's say you have bank A holding lots of cash, more than it needs, and bank B has a lot of treasury bonds, but it needs to raise cash, right? Maybe to meet depositors' liabilities, or the reason could be something else as well. So, and that is something I have tried to depict here in the flow chart. Okay. In a repurchase transaction, Bank B will sell treasury notes to Bank A and enter into an agreement called repurchase agreement, which says that Bank B will repurchase its treasury bonds from Bank A at some later point in future at a higher price than what it is sold for. Now, usually in the repo market, the duration is up to 48 hours. But in some cases, it may be longer depending upon the terms and conditions of the repurchase agreement. Right now, this transaction from B perspective is called repurchase or repo transaction, and from A's perspective, it is called reverse repo transaction. The difference between the price that bank B sold treasury bonds for, and then the price at which it purchased back, is equivalent to the interest rate that bank A charged to bank B. This interest rate is called basically repo rate, right? Now, what determines repo rate? Simply demand supply parity. If there is a huge demand for cash in repo market than the supply, then obviously the repo rate will be higher, and vice versa, right? Now, bank A is usually banks, money market funds, federal banks, etc. And bank B could be affiliates, subsidiaries of bank A. It could be, bank B could be hedge funds, they could be brokers, they could be investment banks. Now, before entering into such a transaction, Bank A and Bank B sign an agreement which lists down the details of transaction like repo rate, collateralized security details, which is in our example here on the screen is treasury bond, involved parties, their relationship, when I say relationship, some of the things that one should be very careful about is whether there is a member bank and affiliate relationship between the two entities that are engaging into repo transaction, right? And this is also very critical from the controls testing point of view. Some of the things, and this is going to be the next thing that I'll be talking about. uh, uh, you know and that is something which is going to keep this session a bit distinct from the other videos, or learning avenues that you would have gone through from the point of view of repo and reverse repo transactions. Right. So I think, in a nutshell, that is all about the repo and reverse repo transactions. I mean, not nothing very complicated about it, right? Now, I will move on to talk about what are some of the things that you need to pay heed to, from controls testing point of view. Okay. Uh, Now, so let's say, I'm looking into a repo transaction and considering, let's assume that BNPP is bank A. So the first thing that I would like to check is whether Bank B is an affiliate or subsidiary of BNPP. And the reason is, most of the anomalies discovered by regulators across jurisdiction in repo transactions are when such transactions happen between a parent banking entity and its affiliates. In such transactions, there is a heightened risk of parent entity passing on repo rate benefits to its affiliates. Now, what does that mean? Right? I know I'm slightly talking about some of the other peripheral things as well. For example, Regulation W from US perspective, and there are other similar regulatory requirements across the globe that talk about arm's length and other things which I would cover in my subsequent videos. But I think at this point in time, what you need to understand is, uh, across, I mean, globally, the regulations are set in a way that discourage any member bank passing on any type of benefit to its affiliates, period, right? So when you are talking about controls, and when you are performing some sort of control testing, and you're looking at the repo and reverse repo transactions, then that is the most important aspect that you need to look at, that whether the parties which are part of the repo agreement, is there any covered relationship with them, right? When I say covered relationship, obviously I'm talking about, is there a member bank and affiliate relationship between them, right? So that is one thing. And then, you need to see if at all there is such a relationship between the two entities that engage in repo transaction, then you might need to understand, or you might need to dig deeper to evaluate whether the bank, is the parent entity, is passing on some sort of benefit to its affiliate. What those benefits could be, right? Those benefits could be that if bank B had to go and borrow a short term loan in terms of a repo transaction from anyone else, what if outside bank B was getting the loan at a higher interest rate versus uh, the lower interest rate that it would have got by reaching out to its parent entity, right? So when you're performing controls testing, you have to evaluate those aspects and rule out any such kind of rule out any such kind of possibility. So I think that's all I have to talk for now. And another goal for me was to keep the session as short and crisp as possible, and then later on to elaborate any specific aspect that you would like me to in my subsequent videos. So with this, I will end this session, and look forward to have some engaging discussions in the comment section with you guys. Thank you so much for your time.